where do we where do we start? Um, where do we start with our deal? So this is a deal email that we all hope to send to our providers, and I received this, and I wanted to start here. The deal is closed! Exclamation point. Um, I worked with this buyer, and on day 89 of his 90-day due diligence timeframe, um, he successfully completed and closed the transaction. This is the end goal for those actively searching or under LOI. So, how do we get there? Let's take a step back and understand what are the many emails, discussions, negotiations in order to fire off this email that your deal is closed and you are the new owner, operator, or majority shareholder of the business you're pursuing. So, what are some of the challenges faced by independent sponsors? So, this webinar is tailored to indie sponsors, but it also applies to the self-funded search community. But I wanted to start with the independent sponsors. So, there are capital constraints. Um, there's hyper deal sourcing and competition across other independent sponsors, um, as well as competition in the marketplace. As larger self-funded searchers go after deals which exceed the SBA $5 million limit. These are some of the challenges faced by indie sponsors. Independent sponsors will be buying companies with a management team in place, and they will be sitting at that holdco level. They won't be operating the business on a day-to-day basis, but you may be getting your hands dirty early on, and you have mandates by your investors to generate significant returns and then develop an exit strategy. It's very much a and hold, and sell strategy versus a self-funded searcher. You may be looking to buy and hold indefinitely. And I know there are differences of approach for independent sponsors, but in general, these are some of the challenges they face. And then fundraising for these larger deals, investor relations, and then, of course, the legal considerations. So when we think about the 90-day time frame, what does it look like in reality? So this is something I use in all of my deals, and this is a good framework which shows what are the various teammates and levers you're going to have to hire and activate in order to go from that signed LOI to the final business purchase. And the ability to send that email that says the deal is closed, super excited to be the new owner operator, and just thanking the service providers that are listed here who helped make that possible. I always encourage folks to develop a strong deal team because you, as the quarterback and the hero of this journey, need to surround yourself with competent individuals to focus on the various aspects of the due diligence process. And you can sit at sort of that general manager, COO role during this process. So if you want to take a screenshot of this and save it to your desktop, I often will refer to this when I am under LOI with some of my clients. So where do we start this journey? It starts with something like this: a signed LOI. I'm gonna walk through a series of emails for a recent deal that was late last year to show some of the actual fundamentals of what this timeline looks like on an actual basis for a single deal. And I think it's helpful because While frameworks and theories are good in practice, until you actually go through the reps of reaching out to providers, signing that LOI, and connecting the dots, it's hard to see a full picture of what your deal looks like and what you actually have to do. Because there are dozens or hundreds of things you need to do during this 90-day time frame or 120-day time frame, whatever due diligence timeline you have. So it starts with the signed LOI. In the signed LOI, I was contacted by a client to kick off a quality of earnings. When you have a signed contract, it's important to kick off the QoE because you need to largely substantiate the financials which you submitted a bid on, and the financials presented in the SIM or other marketing materials are largely unverified. So why are they largely unverified? Uh, the materials you reviewed likely were prepared by the business broker or seller representative, but you have not been able to examine the granular basis of these financials. There could be issues in the accounting system or manipulation that you aren't able to see until you look under the hood. So that's really why it's important to kick off this QoE early on. So day three is the QoE kickoff call. It's important, right away to start this process. So you'll see that on the third day of due diligence, we have 90 days total to analyze all facets of this business to kick off, with this kickoff call to start the QoE right away. I always encourage folks to start this sooner rather than later. And the reason is it often takes a week or 2 weeks to obtain a lot of these documents. So the sooner you can get started with this, the sooner you can begin starting legal due diligence, as well as tax due diligence and the other areas. Day 22, this reads conversation after the QoE. So it took us about 3 weeks to complete the QoE. And from there, we assessed the financial data and we gave the buyer the information he needed to complete this first phase of due diligence. So let's look back at the due diligence timeline. Typically, financial diligence is supposed to start on day one. It can extend through day 60, but the bulk of the QoE is completed in that first 30 days. So what's kind of next on our list? Next on our list is we have the bank underwriting process. So this email reads, SBA business acquisition. Good afternoon. I hope you're having a great week. The SBA lending has approved your loan proposal to purchase. I've attached the loan proposal for you to look over. It's going to be valid for 5 days. This is what is also known as the SBA term sheet. It's been approved through initial fundamentals of the bank, but it has not gone through the formal underwriting process and then the approval. Getting a term sheet approved from a bank is a big win. So that's what this looks like in reality from one of these banks for this deal in particular. From there, the loan underwriting process begins. So this follows either in line with when the QoE is being completed or it's very close after. And the loan underwriting process is a formal process by the bank, which they will ask dozens of questions about you, the buyer, the company in question, tax returns, etc., to verify and vet the financials and ensure it meets their lending standards. You'll see here the formal loan underwriting process can be an arduous and time-consuming process. Um, for purposes of security and privacy, I went ahead and just blocked out dozens of emails between myself as the QoE provider and the underwriters and the buyer, my client. Uh, the back and forth of underwriting can be extremely time consuming and frustrating at points. The underwriting committee typically will assign you one individual who will be conducting the analysis and issuing that letter or opinion to the formal approval. Um, there will be back and forth, and uh, throughout the process, you may be asking yourself, like, I'm explaining the same things that I talked through during diligence. So it's important to leverage the work of a provider, like QoE provider, to help you through this process because we've done a lot of this work already. Um, for example, in this deal, they had issues around the DSCR ratio as well as some of the owner add backs. A lot of what we completed during the QoE was leveraged during underwriting to get them comfortable around the business and the optics of it in order to get approval for that loan. You'll see here that the loan proposal was approved, and they use the QoE to digest and get comfortable around it during the underwriting process. So if we go back to that timeline, it's important it's important we start financial diligence and the SBA bank underwriting process, if not in conjunction with each other, very closely to it, because a lot of the documents they will ask for during underwriting have already been completed in the QoE, and you can leverage the QoE provider you've already hired to assist in that process. Um, Not all providers are willing to do this. Fortunately, my group is prefers to be involved because it increases the certainty of your ability to close. Um, there are no guarantees what the underwriters will conclude for the bank, but I have seen in practice a higher probability of closing when we work closely with the banking institution and the buyer client during this process. So if it's for an SBA loan or a conventional loan, the process is virtually the same. It is just different people and different criteria. Um, the assessment of the credit risk is really the number one priority when we're thinking about these things. So I'm doing two more detailed webinars around income statement review and balance sheet review and how to specifically conduct these during the due diligence timeframe as that QoE provider. So if you're trying to conduct preliminary diligence, if you're before an LOI, these two webinars are going to be really hands-on, roll up your sleeves types of learning materials where I walk through a P&L and walk through a balance sheet, and I talk through some of the questions I would be asking. So if you'd like to, join in on that, I'd love to have you. Okay. So going back to the timeline, shortly thereafter, underwriting was approved. Um, Let me see if I can do this. And I'm going to try to zoom in. Okay. Yeah. So shortly thereafter, underwriting was approved. Our buyer requested an additional line of working capital. So after discussions with the buyer, he realized that they needed more cash in order to sustain business operations than originally anticipated. The working capital, as stipulated in the LOI, was more of 250,000 or 300. They were going to need an additional line of credit or working capital to be included in the loan. So this had to be we contacted during the underwriting process about this request, and from there it almost reopens the book of the credit risk committee. So there are several negotiations and things that need to take place in order to get approved for that additional amount. From there, again, there are several discussions around negotiations. What does seller transition look like? But the SBA bank loan was approved. The purchase price agreement was signed. That extra working capital was delivered. And this buyer successfully completed um, the signed LOI to business closing on day 89. So this is an example of that quick 90-day process, and there's a lot more to unpack, but these are some of the actual tangibles of a recent deal, so hopefully you found this valuable. There are going to be other things not included, such as the intros for the M&A attorneys for them to conduct legal due diligence. If we think about the days, that typically happens in the last 30 days of exclusivity. So it's very close to the end of the process. And that's because the M&A attorneys are responsible for the purchase price agreement, um, as well as some of that legal diligence and reps and warranties, which are at the end of the process. So what does this process look like at a very high level? It's going to include things such as the LOI, which picture, that's day one. The due diligence period is the days 2 through 60, call it, where the buyer conducts operational, legal, and several other types of due diligence in order to gain comfort around the financials. Um, Then it's going to move into the purchase agreement, which is the legal binding document prepared by the M&A attorneys, where it stipulates the provisions of the transaction and really formalizes the agreement into the future. Closing, very close to the end of the process. Think in the last few days of the exclusivity timeframe. These are going to be some final negotiations. Um, Maybe introductions to key management right before you sign that purchase agreement and formalize, the agreement. So we have a couple questions come in, so I'd love to take one. So what preliminary due diligence can a searcher complete prior to a QoE so he or she is not spending money on QoEs for every deal? So that's a great question. So whether or not you hire a QoE provider or complete the analysis yourself is entirely up to you. Um, Most banks will mandate some sort of third-party due diligence is completed in order to obtain a loan. And the reason why they're mandating it is from a credit risk standpoint. Um, they feel more inclined, and you gain credit as a buyer if you're willing to spend a certain amount of money hiring a professional CPA firm in order to conduct this analysis. With that being said, until you have that LOI, you should be able to conduct these sorts of analysis. yourself or with your team if you are supported by one. Things like assessing the financial health of the business, making sure the deal pencils based on some of the bank underwriting standards. Um, if you're not an accountant or not familiar with financial analysis, I would encourage you to find folks in your ecosystem that can help. In some instances, QoE providers can help before you do engage under LOI. More often than not, it doesn't make sense from a dollars and cents standpoint, but you, the independent sponsor or business acquirer, needs to make that decision for yourself. With the demand and the interest in the space, a lot of these providers are very busy with deals with buyers who have no problem spending that kind of money. So if you are budget conscious, I would encourage you to do it yourself. And once you do reach that inflection point with the bank, work with one of these providers, and they certainly can help you from that LOI period to closing. So what does your team look like? And we kind of touched on this, but it's always nice to look at a visual. So the diligence team who is going to be with you for these 90 or 100 and 150 days is going to be likely a CPA who's going to conduct a quality of earnings review, um, an attorney who's going to conduct the legal diligence and draft the purchase agreement, which includes the reps and warranties and other contract language of your deal. And then you may have things like an M&A advisor who may sit with you to provide that additional level of support and structuring and negotiation, as well as I've seen folks bring in industry experts to help with operational uh, aspects of the business. For example, in practice, I've worked with a few individuals who have purchased manufacturing companies and they've brought in retired owners of some of these manufacturing companies to sit on their board to act as that industry expert and provide some operational insights. Um, Lastly, every deal is going to have a bank partner, which is going to be a banking institution that is going to provide you that loan. Now, I wanted to make an important call out because this is talked about in practice. The bank is really not a member of your team. They are a vital component in order to buy this business. But there is a clear line between folks like a QoE provider who work for the buyer and a bank or institution that works for their own bank. Um, just because a bank is willing to give you a loan does not mean the bank has fully verified the financials of the company and makes it a good business. Um, The bank credit underwriting process is far less intensive than what is conducted during a QoE. So I would encourage you, if you are pursuing a small business, especially sub 5 million, um, keep in mind that just because the bank is willing to give you a loan on it and it meets their credit risk, underwriting box, that does not mean the business is a good business to buy. There may be significant pitfalls. Most bank underwriters are not CPA accountants, so they don't have that level of expertise in order to ensure the accounting records of the company are prepared accordingly. They are looking from a credit risk standpoint, so just keep that in mind. Um, I do speak to folks who mention this level of assurance around, well, the bank underwriting committee said the deal looks good. They're willing to give me a loan on it. That does not mean the business is viable and supportable and something you should buy. So just wanted to call that out because I do see that a lot in practice. And that's a fundamental flaw in some searchers who are doing this for the first time. Another area of due diligence is tax due diligence. So some firms, like O'Connell Advisory Group, we have a tax due diligence team who specifically focuses on state, federal, and local taxes. and works on structuring. So asset versus stock sale, or others, or some of the other structures you may be considering. Tax due diligence is very important because there may be uh, undisclosed liabilities or tax issues, and you don't want to walk into those on day one of closing as that new operator. So when we think back to this timeline, tax due diligence is a big piece, which often goes overlooked. Occasionally, legal firms can also help with tax issues and compliances. Um, Fortunately, I am supported by wonderful tax experts who help assist my deals. So if you do work with us, that's an added benefit. Regardless of who you go with, make sure some level of tax diligence is completed, so you ensure you're not walking into a large IRS bill on day one or an open lawsuit from the IRS on day 10. Eh, let's see, a couple more questions coming in. So how, in terms of the cost structure around some of these providers, I know with the SBA, you can submit detailed invoices for the expenses paid to the QoE team, and those can be approved and complete and issued to you at the time of closing. Uh, I've done this on dozens of occasions, and they are always approved and completed. There's certain paperwork and a paper trail you need to submit. So if you are concerned about some of these costs, more often than not, most providers won't work on a contingency basis, especially if you're an attorney or CPA who are supported by teams. They need to make payroll as well. Um, with that being said, there is some flexibility in it if you with a small deposit up front, and then maybe a larger portion paid close to closing. Regardless, if your deal does make it to the closing table, all the invoices you've paid can be submitted and approved for reimbursement from the SBA bank. If you have questions around that and you're under a deal, I'd be happy to answer them. So, what are some of the what are some of the risks of what are the key focus areas and the unique risks of some of these businesses? So, for the last few minutes, I would like to cover that. So, if we look at this, which is included in my buyer's toolkit, if we think about some of the industries you're interested in, let's start with technology. What are some of the key focus areas you should be worried about in diligence, and then what are some of the risks? So, in technology type deals, uh, ownership around the IP, the scalability of the tech, and the cybersecurity is a lot of the key focus areas. Of course, things like the profitability of the business and the key customers should be a focus as well, but these are some of the additional risks. Um, in things like manufacturing, which I spend a lot of time in, uh, the capital expenditure needs is a key focus area. So, what has the business been doing from a CapEx standpoint? Have they been investing in capital expenditures, or have they been pushing them off? This is an important thing to understand, and you should ask detailed questions about this during diligence. You can also ask these questions when you're preliminarily assessing these companies. So that's an important thing if you are pursuing manufacturing deals. Uh, in consumer goods, distribution channels, your inventory levels and how you manage inventory is a key focus area. Um, this kind of goes hand in hand. If you have any business that has a significant amount of inventory on hand, you need to understand, are those goods all usable and sellable? Is there a risk for obsolescence? And what does that look like from a dollars and cents standpoint? The assessment of inventory should be a component of your balance sheet analysis, which is conducted by the financial diligence team when they are engaged and commence their project. The last one I wanted to call out here was healthcare. Healthcare has a lot of compliance around HIPAA as well as regulatory risk and the credentialing of some of the healthcare workers, if that's applicable to your deal. Home healthcare is a big space which I work in and I have been conducted dozens of deals. Uh, Things like the labor force and understanding some of the compliance is where a lot of the key focus areas should be. Certainly, things like the customer contracts, which could be insurance companies or it could be private pay, are some of those other key focus areas in healthcare. This gives another snapshot of the diligence buckets during your 90 days. Um, So we've touched a lot on financials, so I won't cover that. But if we double click on things like tax diligence, which I mentioned, um, questions like, are there past tax disputes with the authorities? Are there open disputes ongoing? Um, these seem simple questions, but they can protect a lot of risk, which you may assume as that new buyer if you don't ask these questions. In operational diligence, it's understanding, the supply chain, where are they, what vendors do they use? What does their relationship look like? What is your organization structure that you're buying? Do you have a management team in place? Is it a very lean team? Is it highly owner-centric? Are there inefficiencies in the workflows? Can these operations scale? Is some of the key factors of operation diligence. Legal diligence in conjunction with the focus area of preparing the purchase agreement is understanding ongoing lawsuits, the risks of future lawsuits, and then the rights and ownership, just verifying that the party you're purchasing it from actually owns these assets. Believe it or not, there have been some instances in diligence where some of the ownership uh, structures have not been as clear as originally interpreted during diligence. There may be other companies which own the right to these assets. For example, the buyer was purchasing 100% stock of company A, and it turned out that the uh, some of the assets were owned by the owner's other company, which was company C. So without including those in the stock purchase, they actually wouldn't have the rights to those assets, which they thought they would have owned. So understanding the nuances of the ownership and how it relates to your deal is something legal diligence should cover. So I have a financial diligence checklist, which if you're under LOI or actively searching, it'll give you a snapshot of the key data documents you need when you are trying to conduct this diligence. So if you want to scan the QR code, you'll receive a copy right away. While I give people a few minutes to scan that, I had another question that come in that says, can you speak to the risks in the B2B services space? Um, so if you have a particular deal in question, or the types of B2B services you're looking at, I can probably better articulate it. If you don't, I can give you some high level risks. So in the B2B services space, there are significant risks around the supply chain. So if you have supply chain disruptions, they can cause some bottlenecks. Um, Again, it depends on the type of B2B services, especially in the blue collar space. To answer your question, um, in there is a tight labor market, so that could increase, pricing pressure of the labor force, or I've seen some B2B service companies that have challenges retaining talent. So when you're assessing businesses, just understand the organizational, that org chart to make sure, has there been significant employee turnover? Do I need to hire a bunch of people when I assume that the role as that new owner operator? Those are some of the risks I would look out for. Every deal is different, but those are some of the key takeaways. So if we look at the M&A life cycle, um, at the highest level, really the areas of emphasis are, um, once you have hammered out your M&A strategy and your target screening, you'll see here there's a little band that says required level of resources. And required level of resources is how much manpower you will need during the various components of the actual deal cycle. And this is more towards the independent sponsors who are not going to be owning and like who are not going to be day-to-day operators. So when you're developing a strategy, it's very little resources required. When you begin the screening process, that's almost your highest level of effort. You're going to be screening hundreds of companies. Um, and then from there, it begins to tail off during due diligence and as you get closer to the transaction completion. And then it significantly drops down when you are integrating and owning the actual business. This is just for informational purposes. Every deal is going to be different. But if you are sitting at that holdco level and you're going to buy the business but not necessarily operate it, a lot of your resources are going to be spent in target screening, discussions with potential sellers and companies, and that's where you're going to spend a lot of your time. If you have a diligence team, which are your go-to providers, the level of resources you'll need from your end will be significantly less once you do get something under contract, um, because you can focus on capital raising and the ability to get the funds to purchase this business and leverage your diligence team in order to make sure this business is viable. Uh, I've seen this process leveraged over and over again by sponsors who have purchased dozens of companies with the appropriate team that's already set in place, who knows how you like to run a business deal. It makes it a very painless process. If you try to bring in new partners and DIY it, that's when I've seen a lot of the level of resources begin to move past this high to extreme levels. And the risks are you stretch yourself out too thin and you miss a material deal finding, which costs you 10 times the price of one of these providers. So the point of this is, work with a competent team, surround yourself by individuals who have expertise in the space to set yourself up for success.